Many people ask, how does the credit score and down payment come into play when getting their mortgage rates or mortgage pricing? I'm going to go over one of the more common adjustment sheets which is Fannie Mae. Freddie Mac has one that is comparable or similar, and so I could have gone over either one. Now, what these are referred to also loan-wise are conventional conforming loans, also referred to as agency, because Fannie Mae and Freddie Mac are the agencies. And sometimes people abbreviate conventional conforming down to just conventional. Conventional loans covers most loans that are not FHA, VA, or rural housing, which means jumbo loans are also technically conventional loans, but will be referred to as jumbo loans often to avoid confusion. And they're conventional and non-conforming loans, whereas loans that are conventional that meet Fannie Mae and Freddie Mac's guidelines are also referred to as conventional conforming loans. I'm going to just hit this running now. So loan level price adjustments are based upon certain eligibility and other loan features such as the credit score, the loan purpose, the occupancy, the number of units, the product type, and more. All loan level price adjustments are cumulative, which means they can add up and sometimes add up quickly. They apply to all loans that meet the below stated criteria that you'll see as we go through it. This one doesn't really apply anymore. Credit score requirements are based on a representative credit score for the mortgage loan. Now, credit scores are calculated. The lender will pull 3 bureaus, TransUnion, Experian, and Equifax. The numbers of those scores will be put in numerical order, and the one in the middle is your representative score. If you have only 2 scores that come up, then it's the lower of the 2. If you only have 1 score, the 1 score is used. And if you do not have a credit score, then the score for pricing on this table will adjust to the lowest possible score, which in most cases is 620. It will be treated and priced that way. If you have multiple borrowers, then the same calculation is done to get each person's representative score. Those representative scores are put in numerical order, and the lowest of those scores becomes the overall score used for pricing and qualifying. I'm going to shoot down to the tables. So let's start right here on the first table. And this is all eligible loans, loan level price adjustment based on credit score and loan to value ratio. So what we have here starts with the credit score ranges, 740 and higher, 720 to 739, 700 to 719, and so forth. You'll see each credit score range. They generally run in blocks of 20, or everything 740 and above. Could be in the 800s, or all treated the same. 620 and below is for some special programs and generally will not apply because in most cases you need at least a 620 score to apply or to qualify. Across the board here is loan to value. And so what the number means, like this is 60% loan to value. It means the loan amount is 60% or less in relation to the value or purchase price. And then so forth, 60.01 to 70, 70.01 to 75. And in each case, being as these are loan to value, the inverse is the down payment. So if you see 80% loan to value, that means 20% is the loan amount or the down payment. 80% loan to value, 20% down payment equals 100%. And these adjusters here, applicable for all mortgages with a term greater than 15 years. So if you get a 15-year loan or shorter, these adjustments do not apply. And I'll circle up on why that can be important, especially on lower scores. So let's just use this highlighted as a baseline. Let's say you have a 740 or higher credit score and you're doing a 20% down payment on your home. And a lender says, well, I can give you 0 points at X rate right here. You go, okay. And you go, well, what about if I do 25% down payment? Well, at the same rate, not only is it 0 points, but now you're going to get a 0.25% roughly, lender credit. It's not spot on exact. Some lenders' price can adjust slightly based on the loan amount. And of course, the loan amount be a little lower here than here, but it should be close. And then what that means, a 1/4% lender credit, let's say your loan amount's $200,000. Well, 1/4 point lender credit would be $1,000 toward your closing costs, whereas here you'd have nothing toward your closing costs. And again, let's assume this is inherent in already creating a 0 points. If you do 40% down or more, now there's 0 adjuster, which means half percent lender credit. And actually, on this 1/4% lender credit, that's a 1/4 point lender credit is $500 on $200,000, and a 1/2 point. Now you got a $1,000 lender credit on a $200,000 loan if you're doing 40% down to get to that loan amount. And if you put less than 20, the adjusters reduce a little bit again until you put down less than 5%, and then it goes up some. Now let's say your credit score is 720 to 739. Well, now the adjuster's 3/4. So at the same 20% down, your rate that was at 0 points with a 740 score is now going to cost you a 1/4 point because the score's a little lower. So now you've lost your 0 points, a 1/4 point. Or if you don't want to pay the 1/4 point, there's 2 ways to take care of that. One, put more money down. Now you'll see these are equal. So you're back to 0 points at 25% down. Or in this case, or you can ask to have the rate increased a little bit to absorb that extra 1/4 point. So you can get the interest rate to increase. Again, 700 to 719 score. Now it's 1.25 points loan level price adjustment, which is 3/4 of a point higher than here. So if you want this rate that was at 0 points, but your score is now 700 to 719, you're going to pay 3/4 of a point to get that rate, or you can ask for a higher rate that will absorb that 3/4 of a point. Now, if you come down lower, you notice the adjusters get larger, especially on less down payment. Once you're 40% down, then any difference is there isn't one or it's minimal. So if you got a low score, a big down payment will help. So if you're down 660 and you're doing 40% down, you're going to get the same price as somebody at 740, at least in terms of the down payment here, and only a little extra 1/2 point here. But if you're 20% down, it's about 2.5 extra points on this score versus up here to get that rate. And if you don't want to pay the 2.5 extra points, then you're going to have your rate increased to absorb it. Or because it does not apply to terms 15 years or less, if you have a lower score, another option is to do the 15-year fixed rate. And the reason being, whether you got a 640 score or an 800 score, you're going to get the same rate on a 15-year fixed rate loan as opposed to the longer loans. So as a consequence, number one, the 15-year loans tend to price cheaper, and two, without the adjusters, you can find a huge difference in rate if you have a lower score between doing a 15-year fixed and a 30-year fixed. So many of my clients who have a lower score opt for the 15-year fixed for this reason. Additional product features, adjustable rate loans, not really any adjusters in there. Manufactured homes. If you're buying a manufactured home, a 1/2 point's going to be hit to your pricing right there. So you can pay the 1/2 point extra, or you can, again, ask to have it absorbed into a higher interest rate. Either way would apply. Second homes, no real adjusters there unless you're doing less than 15% down. And then investment properties. They have adjustments across the board. The sweet spot's to do at least 25% down. The adjuster's only 2 1/8 points. If you're doing less than that, it jumps up to 3 3/8. In addition, even the base adjusters are higher versus here. So it's a considerable savings on an investment property if you do at least 25% down. Again, either the points are going to stack up or you can have the rate increased. Many cases, if you're doing 20% down on investment property, depends where your score is, the rate can't be increased enough to absorb it all, and you're still going to end up with points. So again, a good sweet spot on investment properties, 25% or more down. For refinances, if you're taking cash out, and that doesn't mean just a nominal amount, generally it means if you're taking more than $2,000 out, with some exception based on the loan amount, you're going to have adjusters here. Or if you're combining two mortgages in which the second mortgage was not used in whole at the time of the purchase of the home, you're going to have these adjusters. And this is for conforming loans. Again, Fannie Mae or Freddie Mac. Jumbo loans have a different dynamic when it comes to cash out refinances. So, depends on the loan to value. If you're taking out less than 60% of the value versus 70, 75, or 80, here are the adjustments. On a 740 higher score, as the score gets lower and as the loan to value gets higher, you'll notice that the adjusters get bigger and bigger. So if you've got a lower score and you want to do cash out, if you can, try to stay under 60% loan to value, as it will have a negligible effect on your pricing. High balance loans, generally loans more than 484, 350 for single family homes. In other words, not multi-units, because they have higher loan limits. Across the board, about a quarter point is built into the end pricing. And again, these aren't always pricey, as you'll see, because if you guys want to see 0 points, lender's going to price it out to 0 points, but that's after taking these things into account, and they will find a rate that will absorb these. Otherwise, again, that's just how it comes into play in coming up with your end rate. Cash out refinances on those higher loans, generally above 484, 350, though, is 1 point right there. And then adjustable rates on the higher loan amounts. These are adjusters here. Generally, on adjustable rate mortgages, if somebody's getting a higher loan amount, I find they go with the non-conforming loans because they will not have those adjusters in there and tend to price better. If you're buying a multi-unit property or refinance a multi-unit property, 1 point is added into the pricing across the board. And again, to get rate X that we showed above, that would be added in points. Or if you don't want to pay the points, then you'll absorb it in a higher rate. Condominiums, and this only applies if your loan's greater than 15 years. If you're not putting down at least 25% down or borrowing more than 75% of the value, there's a 3/4 point hit add-on. And again, that can be added to closing cost or absorbed in a higher rate. Either way. Or, again, you could do a 15-year loan and avoid that. Not really going to get too much into mortgage with subordinate financing. This really just comes into play if you're combining two loans with your purchase, or if you're refinancing your first loan but keeping a second loan that you have open and available. This one's kind of rare too, and these are loan level price adjustments based on what they call minimum mortgage insurance coverage. In exchange for a reduced mortgage insurance coverage, which equates to slightly lower mortgage insurance, you will pay more in costs. This is not something I see much of. Many lenders don't offer it, or investors as well in either case, so it's not something you will come across very often. Home ready mortgage loans for people that qualify, and that's a program in itself. If you qualify for the home ready mortgage loan, then it has loan level price adjustment caps. If you qualify for this loan and you're doing less than 20% down payment on your new home and your credit score is 680 or higher, the caps are 0. What that means is all the above loan level price adjustments are wiped out. And as a consequence, you end up with lower cost or lower rate, or combination of two, however you put it together. If you're putting down more than 20% or your score is lower than the 680, or a combination of both, then it's capped at 1.5. So if you add all the adjusters above and they exceed 1.5, they're reduced down to 1.5. And again, that's either going to be in points, or you can ask to have a higher rate to absorb it and bring you back to 0 points. Hope you found this helpful. If you have any questions, just leave comments below and I'll answer them. And you can always go to my website to contact me. The link's in my profile. Thank you very much. Bye-bye.